put a bit about your startup in the chat, and that would be great. Thank you all for joining in today, and I'm sure it's going to be very very insightful and impactful for everyone. Just a quick house rule. I'm sure everyone will have questions during the call, right? Please just note down your questions, and at the end of the session, Ofyong would take all the questions one at a time for me to sort of help every founder out there that is looking for answers, right? Get answers to their most prevailing questions, right? And I'm really excited that Microtraction is the one I'm doing this with, because if you are familiar with the venture space in Nigeria, Microtraction and by extension, Yele Bademosi are one of those that really built this space, right? And they've been doing amazingly well so far. They've invested in a number of startups that we've come to admire today. Carry Wise being one of them, Bumper being one of them, and etc. etc. And it's really really amazing to partner with them to be able to like share knowledge with founders out there. And Ofyong is here today, so it will be the one leading the discussion. Where are you? Show your face.
Can you see me now?
Yes, perfect, awesome.
Yeah, happy to be here. My name is Ofyong, everyone. Ofyong is here. I'm a senior member of the Microtraction team. And Microtraction, as Bayomi had said earlier, is a leading early stage VC fund. And we've been investing in early stage startups since about 2017 to date. The likes of Wise, Lemfi, Foodcourt, Vesty, and many more, many more. So it's a pleasure to be in this community today.
Awesome. Great to have you here. I think we should just get straight into it. And please, everyone, if you have a question, please note it down, and then at the end of the session, we'll go through all of the questions. Yeah, thank you. Ofyam, over to you.
All right. So please confirm if you can see my screen. Yeah. I can see it. Just 1 second. I'm going to switch up my camera to save bandwidth. All right. Please, I can't see anything, only my screen and my slide. So I presume everyone can see my screen. But can you confirm, please?
I am struggling to find where it is. Can everyone else see it is
No, I cannot.
I can't see anything.
No, I cannot see that.
Okay. So maybe reshare the screen.
Let me try again.
And then I'll pin it.
How about now?
Yes. Perfect. Awesome.
See the screen now.
Yeah,
all right.
Yeah.
All right. Okay. So everyone, pleasure to be here today. My name is Ofyong, as earlier said.
Later, okay. I'm in a meeting, yeah?
Hello. It will be great if we can all mute. It will be really, really good for us to have a seamless conversation. Yeah. So today we'll be talking about venture capital funding 101. And I presume we all have questions. We have some things we want to clarify, comments. That's fine. I mean, at the end of the day, we would have a chance to ask questions. Please, as I go through the slides, I would need your undivided attention, to be honest. And you please note a couple of things down that you want to ask. Hopefully, I'm able to clarify along the way. But if for any reason you have questions, you have comments, or you want to ask personal questions about a startup or the project you're working on, I'm happy to address it. So today we're talking about venture capital funding, and I want to be very honest with you guys. I'm going to be as precise as I can. I'm going to be as clear as I can. And I don't want any form of ambiguity in like throughout my presentation. So first thing I'm going to do is talk about venture capital. So the venture capital firm is an investment firm that provides funding to high growth startups in exchange for equity. And the whole purpose is for them to have a liquidity event in the form of exit. So we're talking about acquisitions or IPO. Now, a venture firm pools money. I have to explain exactly how and why VC operates the way they do, and why they say no a lot, and why they say yes to certain type of startups. So VC pool money from outside investors into a fund. You want to imagine a fund as a container, a vehicle, or a structure. And through that fund, they kind of direct investment to companies, to startups as yourselves, seeking for capital or funding. So a VC firm is literally like a startup, except that one writes check, the other writes code. And as you can imagine, they are in different strata. So stages of investment define venture capital. Venture capital firms are divided into different stages that reflect the maturity of the business they invest in. So for example, Microtraction, we invest in early stage, like pre-seed. So our early stage investment is targeted towards certain type of businesses. That is for the ones that are yet to raise, or the ones that have raised a few amount of money. Those type of companies are early stage. And for the sake of clarity and precision, early stage investment can be bucketed into pre-seed to Series A. And most times, I think for the sake of precision, we want to just put them in pre-seed and seed stage. Each stage is between Series A or Series B, and these are for companies that have reached or attained a certain level of product market fit. Now, for growth stage investment, or what we call late stage, these are companies that have already reached a verifiable, demonstrable product market fit, and they are positioning themselves for acquisition or an IPO. There are different types of VC firms. There are firms that are generally thematic or thesis driven. And it's very key that we understand what these different firms do, because they're not all the same. Of course, they write check, they sign deals, they invest in founders and their startups, but they're not all the same. Generally, these firms invest in companies in almost any sector. So they are called sector agnostic: healthcare, fintech, AI, edtech, all sorts, right? And they are thematic firms, VC firms, that invest in companies operating in certain verticals and addressing certain type of people, like communities, like tech companies serving low income communities, people of color, or gender specific. They are now firms that are thesis driven rather, and they have a clear, well defined investment philosophy about what works and what doesn't work. This can be as a reason, or by reason of their experience in terms of technology trends, the future of the market, and how they see things evolving. And there are also VC funds, or firms rather, that have geographical focus. So, for example, like Microtraction, for us, we have a geographical focus to invest in Black founders, African founders. Our mandate is in Africa. We don't invest in European founders. We primarily just focus on African founders. And that should be able to capture, I think that kind of captures all about different type of VC firms. Now, what exactly do VCs look for? I'll answer it in a nutshell. Venture scalable startups. When a VC is looking through a deal, startup like yours, hypothetically speaking, they're trying to ask themselves, can I see a pathway to $100 million in revenue and a consistent way to compound that revenue from there on? Is this business building a category defining business in the order, kind of like in the hundreds of millions, or even to the tune of $1 billion in revenue? Because that is a very, very, very important frame of reference for a VC. Now, you might be asking, it's too early. I just started my business. I just started my startup. I think there's a very, very important thing that we need to clarify. A startup is designed to grow. If it's not growing, it's not a startup. There's a reason why startups are high growth for a reason. High growth is different from an SME. A SME, or an SME rather, grows linearly. Startups are expected, and we've seen this by virtue of our experience in the space. Startups grow exponentially. I've seen startups go from 500K to multiple millions of dollars in revenue, and that's because they are designed and they are functional to be
Is it just me or we are losing him?
high growth. They start off and they take off. And I think it's very important to start something here. route. And you probably should. There are very many ways of getting funding. Crowdfunding, bootstrapping. There are different ways. Exploring grants, options. But if it's not venture scalable, I think it's very, very key that you explore those alternative those alternative funding routes. A simple rule of thumb, if your mic is on, it would be great if you can mute. A simple rule of thumb for what makes for a venture scalable idea or venture scalable company is that pathway to $100 million in revenue, right? And can you grow very fast? Can you grow big? For example, I believe we invested in Lemfi in 2021 or 2020, and I still saw the numbers, right? I saw the numbers then, and I'm amazed that they are where they are now. It's not even the end of 2025. In the space of about 3 years, 4 years, they have grown ridiculously massive. That's an example of a fast-growing, high-growth tech startup. Now, very few ideas will hit that scale, and you must recognize that before you take venture capital. It's very key. And here's why. The profile of a venture scalable startup is in this format. Like, it has to be built in a large enough market or a growing market. I think the real one I want to emphasize on is growing market. When Paystart started building what we know as Paystart today was around 2015, 2016. And as at that time, the online payment business in Nigeria was ridiculously small, smaller than what you could imagine, but it was fast growing. Something can be small, but ridiculously fast growing. A lot of things had to converge for them to get to where they are now, but they built a business on on a growing market, in as much as it was not so large back then. Because at that point, it was very difficult to build startups, make or charge customers was quite difficult online. They came in, made it very easy, made it very simple. Those two things are not the same. Simple and easy are not the same. And they ensured that the market grew, because if you could collect payments from customers online, more people will come in, more business. It was like a flywheel, and the market kept growing. And eventually, we saw what happened. By 2020, rather, they were acquired by Stripe. So you need to ask yourself, are there enough people or companies in this market that's spending enough money for you to be able to generate $100 million in revenue per year at a point in time, or eventually $1 billion in revenue, in a year? Is this business scalable? So this is also a very, very key thing. Like, scalability is one thing that most people don't tend to consider in terms of running their business. And if you're running a startup, you want to consider scalability for efficiency, primarily through technology. And that does not eliminate, what you are building, or it doesn't need to change from the ground up. From the preliminary thinking process, you want to make sure you are including technology to scale your business. That does not include hiring more people or acquiring depreciating assets like buildings and all the likes. So you want to make sure your business is scalable, especially through technology. The next one will be high growth. Can this start up 2x or 3x? Measure what matters most. And for a startup, you want to measure your growth rate tied to your North Star metric on a year-on-year basis. And if it can 2x, 3x, can you keep it up? Like, what are the indicators that suggest that this startup can continue to grow? I was speaking to an investor last year, and he was telling me that it is serious to me, or else you won't be able to raise large amount of money. This is in India. Anyway, that's an aside. So in medium term, if that is not so clear, I don't see any reason why you want to sell a big percentage of your company to an investor if you don't see how money can help unlock growth. The reason why VCs invest in startups is because, like I said, we're investing in high growth startups, companies, businesses. And you want to ensure that if you are bringing money, that money is helping fast track growth. You don't want to invest into an SME because of reasons that you later figure out to be true. Pathway to exit has to be very, very clear. Who is going to acquire this company? Does it get acquired or is it going to go public? So, in as much as we're stressing the whole point of venture scalability, I think it's also very good for us to touch on a couple of things. If you're excited about non-scalable, non-venture scalable ideas, I think you should build it. There are examples of non-scalable ideas. An example is Trello, right? Trello, at its best, I don't think it crossed $20 million in revenue, annual revenue. And of course, you can get acquired. You don't necessarily have to go the VC route. And there are a lot of great products that are not, venture scalable. The mistake is that you think your idea is venture scalable, and then you jump on the VC treadmill and it breaks the individual. Now, the reason why you jump on the VC treadmill and your product is not scalable, your startup is not scalable, this is what can change. The expectations are, they are very, very painful. They are very painful, especially when you're not positioned for a venture scale expectation. VCs are looking for things that will grow very big, very fast. And if your business is not tuned or suited for that type of growth, it can be really, really painful because of the expectations are so much. It's like telling a mom and pop shop to grow their revenue 4 times in a year. Like, how will they do that? That's a lot of logistics, a lot of planning, a lot of difficulty in making sure that kind of thing happens. You can actually lose control because when VCs buy equity into your company, they tend to get a seat on the board. And this is not for early stage startup. I'm talking about in the future. And you can lose control. And losing control could actually mean you lose control over the direction and decision making at some point, especially if you're not growing very fast. You probably have heard of cases, TechAbout, TechPoint, or TechCrunch, or whatever, where VCs take over startups. These are situations, likely situations that might actually happen. So you want to also take into consideration, is my product or my startup venture scalable? If it's not, perhaps I should explore different ways of getting money. Ongoing dilution. When you attempt to raise money, and you're not performing well, you will raise at lower valuation. I tell founders this, your idea, it's fine to have an idea, but it will be ridiculous for you to think that everybody else is raising at 10 million, I should raise at 10 million. People don't understand that valuation is a first function. The moment you raise at 10 million valuation, your next valuation cannot be lower than a 10 million valuation because it places your early investors under pressure to take a haircut. We call the haircut because other people are going to come in and dilute their position on your capital. We'll talk about dilution, we'll talk about all these key concepts. And then the last one is exit pressure. You see, VCs expect you to have an exit event. We call it a liquidity event. It could be an acquisition, it could be a secondary sale of shares, it could be an IPO within the space of 5 to 10 years. And they need to do that because they have to return money to their investors. We'll talk about that in a few moments. This could actually lead the founder to prioritize short-term gains or short-term options over long-term health and vision of the company. If, the key word is if, you are not a venture scalable startup. Because if you're a venture scalable startup, all of these things I just pointed out and many more will not hurt you. There's also this last few points I want to touch on. Now, you need to consider that the market is a very key thing, especially for early stage startup. We talk about product market fit. It's a two-sided thing. There's a product and there's a market. The key thing, the major thing of emphasis is the market. Is the market big enough or is it growing? And you want to be able to do the math. I don't expect, and to be honest, I'm someone that's very, very thorough. If I see a random statistics on your deck or something, I can really hammer down on it. Like, why do you pick this figure on your market? Like, you tell me from a random McKinsey or a Bain report that this market is whatever $1 billion big. Prove it. There has to be a bottom-up approach on how you size your market. And it's very, very key. We'll talk about an example of that. You also need to consider that in how a VC perceives a startup, they're asking themselves, does this startup have a competitive advantage compared to their competitive alternative? That is, do you have a unique differentiation? I'll use the case of the Paystack. Paystack was not the first to do online payment. It was InterSwitch before Paystack, but it was ridiculously difficult to use InterSwitch. I think at that point in time, before 2015, you have to pay 150,000 or thereabout. I can't remember the figure now, for you to be able to use InterSwitch solution, their own online payment solution. Paystack came in and said, we're going to make this simple and easy for African merchants to receive money from anywhere in the world. And they did that. That alone was a unique differentiation. It's not about being cheaper. They made it very simple and they made it very easy. They're not the same thing. I keep telling founders a lot. Because you use the keyword simple and easy doesn't mean the same thing. But they did both. They made it very simple and they made it very easy. And if you also consider the fact that we live in a low trust business environment, that was something very key for you to punch in your card details into a website, and the payment service provider is an African or Nigerian startup. They had to do a lot of work, right? So you need to come with a unique differentiation, a competitive advantage to alternatives in the market. And differentiation is not just a feature. I see founders just slap, on a table, check mark. This is what we do. This is what that we don't do. That is not differentiation. I'm sorry to tell you, but that's not enough for you to say this is differentiation. A feature set cannot be what makes you different. There has to be much more, and that has to be robust enough to allow you to position yourself differently from alternatives in the market. I think the last one is where I'll dwell more and unpack this layer on layer. On a scale of 1 to 10, you can't choose 5, you can't choose 7. How painful is the status quo? I think I just used the example of Paystack. If you reflect on what I just explained about Paystack, it was very, very painful for people that are running online businesses in Nigeria to collect payment. There were startups before them. Iroko TV, I think, started in 2009, 2010. Hotels to the Entry was existing back then. Online payment was very, very difficult for startups that started before 2015, before Paystack. And then Paystack came in and made their life easier. I'm focused on, tourism, travel. I shouldn't be thinking about payment. Let someone else deal with payment. And it shouldn't be expensive and extremely difficult to use payment solutions on my product. Paystack came in, did the heavy lifting, made their life easier. All right? Is the switching cost from the competitive alternatives to yours, is it cheaper? Like to switch from you to the next guy, is it that simple? I think people don't consider all these things when they see things from the point of the customer or business. You want to ask yourself, and this is a framework that I use, and I've looked at it from successful startups, and I've seen this to actually check out. It's a three-pronged framework. The first one is the frequency of this problem. How frequent does this problem occur? Or that problem space, how frequent does it occur? Does it occur on a recurring basis? You want to consider that. The second one is the magnitude of the problem. To what extent is this thing painful? Some people say some things are very painful, but then when you ask them, will you exchange money for value if I solve this problem for you? Then you now start noticing that their answer changes. That's when you know that it's not extremely painful. The magnitude of the problem is something you also want to consider. Frequency and then the magnitude. Something that occur every other time, but then people can actually bear with it. The last one is the willingness to pay.
23 minutes more.
If it happens every time and it's very painful, are people willing to exchange money for the solution that you're offering? I'll give you an example, Lemfi. Sending money back home is quite expensive. Like if you're in diaspora, sending money back home prior to all these fintech startups, so it's very expensive. They charge you, I don't know how many percentage on that transaction. And then you consider that people back home might not be getting the exact amount. A lot of it was so much just convoluted. These guys came in and said, you know what, we're going to do the heavy lifting. We're going to make sure that you can, from wherever the comfort of your home, send money from the UK, from Canada, from anywhere, send money back home. And people at home can get this money exactly as you've sent it at an affordable rate. And they did that. If you consider the pain of what the status quo looked like, it was very, 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 very painful. And then when you consider the frequency, people send money home at least every other month or every month. And then the magnitude of the pain was that it was so painful, go to the bank, go be sign a check or whatever that was done. The the people do before Lemfire, all this fintech. It was extremely painful. And are people willing to pay? Of course, they're willing to pay for you to make the life easier because they have other important things to do. So frequency, magnitude of the problem, and the willingness to pay. Let's now do a quick bottom-up sizing approach, bottom-up market sizing approach. Let's use an example, maybe a hypothetical example here. B2B cross-border payment company. And let's say we've identified the customer profile, SME and mid-size enterprises conducting cross-border trade in Africa. The industries, okay, let's say import, export, e-commerce, manufacturing, logistics, and professional services. The region we're identifying high trade corridor like Nigeria to Ghana, Kenya to Uganda, South Africa to Nigeria, let's even say to China to Nigeria, UAE, all these major corridors. We want to break it down. So when you consider the fact that there are about approximately 44 million SMEs in Africa, the formal SMEs in Africa that adopt fintech solution, let's assume, these estimates are assumptions, except for this one, about 44 million. The other ones are assumptions. Assume that out of the 44 million, about 10 million of them adopt fintech solution. Of that 10 million, let's assume that 1%, can you guys still hear me?
Yes.
Hello?
Yes.
Okay.
So we can.
Yes, I can hear you.
So if we assume that 1% of the 10 million people are going to do cross-border trade, that's about 1 million businesses. Now let's assume of the 1 million businesses, only 20% of them are tech savvy enough to adopt this payment solution. That's about 200. Now if we break it down even further, the average monthly transaction volume per SME is about 50,000 assumption. Now the business is going to be charging about 1.5% per transaction. And that means you would have about $750 per month, like monthly revenue per SME. The average revenue, if you extrapolate that 750 to a whole year, that's 9,000. That means if 200,000 businesses adopt your solution, this hypothetical solution, and 9,000 is the annual revenue per SME, you have about 1.8 billion annualized revenue opportunity. Now, this assumes that you have full penetration of this target market, which is unlikely. So you can tell me, this is how we think about this problem. This is how we think about the market. This is how we're able to identify the revenue opportunity for us. Don't just bring or extract one random statistic or statista, and say this is the amount.
I guess Google
Bro,
now.
when your idea meets reality, it can literally collapse. I've seen it many times. Anyway, let's now talk about venture capital. Venture capitalists, rather. A startup is considered to be venture scalable if it has the opportunity or the potential, rather, to single-handedly return a VC fund. And if you remember, I mentioned that a VC fund is like a structure, it's an investment vehicle where the VC firm pulls money from their investor to, invest in early stage startup or startups of different stages. Now, a fund size can impact investor relationship with the startup. As a founder, you want to know the fund size of your investor. If your investor, has a $10 million fund and they're investing 1 million, that represents a significant portion of their fund size. That's about 10% of their fund size. Versus $1 billion fund that has about 1%. That's about 1% of their fund size. With a smaller fund, you want to, make sure you are communicating with your investor because they know that you determine their success. 10% of their fund size is in your startup. And they will monitor you closely. They will actually monitor you closely. And they might actually assist you because they have a vested interest in your success. With larger funds, some of those investors might not give you so much attention because you only account for a very minute portion of their fund size. And they don't think, or they might not consider your success to really impact them. And I'll give you an example. But nonetheless, every VC expects that the companies that they invest in, regardless of the amount, will be successful. Now, let me explain because it's very text heavy. I'll explain what this means. In VC fund, like I told you before, they write check instead of code. They are literally like a startup. They also have investors. Your VCs, your investors have investors. They are called LPs, limited partners. They provide capital. And those capital that they have gathered from everywhere is put into a fund. Like I told you, it's like a container. LPs are expecting 3x their original investment. So if Ophion goes to raise 300 million from his own investor. His own investors are expecting him to make sure when he's done dispersing this 300 million, he's going to make at least 900 million. So if I tell you I'm looking for venture scalable startups, the reason is because I also have a very high standard. And it's very difficult, especially when you now start thinking about it to the tune of hundreds of millions or even billions of dollars. Now, for venture capital funds, they aspire to generate 3x net IRR. That's a fancy way of saying they need to make sure they get returns. Most of these firms actually ensure that they look for high growth startups that actually, that are exceptional, the ones that will bring 10x. There's an example here. The example is Baseline Ventures. The Baseline Ventures guys raised $70 million for its first three funds. Three funds. The firm raised $70 million in 3 funds. Baseline Ventures invested about $250,000 into Instagram, and it owned about 12% before Facebook bought it, or when Facebook bought it. And the company was bought for $1 billion. Now, that valued their shares at about $120 million, enough to return 2 times, nearly 2 times the value of their first 3 funds. You can see that the fund size is also a very critical way of how VCs actually sign checks. If this Baseline Venture guys had raised a $250 million fund, the $120 million they had gotten from the sale of Instagram would not have been able to even make the fund break even or even return money to their LPs. Therefore, the business model for VCs is as thus. VCs know that they may lose 1/3 of their investment. They also expect to get their money back from 1/3 of their investment. And they expect that 1/3 of their return will come from the exceptional startup. That's what we call, the power law. Now, most VC funds have
Can you see
a
that
10-year
again?
cycle. That is, within the space of 2025 and 2035, if I have raised $300 million, by 2035, I have to return money back to my investor. It's a must. So if you are raising VC capital, you need to understand that you are also on a timeline. That's why there's an enormous pressure on all these founders, because they have to grow fast. And so that's why I said earlier on, if you're not running a venture scalable startup, please, you might want to consider alternative funding. Next one. To expand on the whole fund size and venture scalable startup stuff, you want to also take into consideration the ownership percentage is something that VCs always target. Now, for example, much of the math around this is around, okay, with a 10% ownership, a $250 million, fund needs to exit for $2.5 billion to return the fund at once. So if they have less than that ownership percentage, it means they may not make money from that high-flying startup. But with a 20% stake, the fund needs to, needs the company to exit for half of that. When venture capitalists talk about ownership targets and what they want to invest, they tend to do this with their own targets in mind. Everybody has a vested interest. You want to grow your startup, you want to make money. They also want to make money by putting their own check into your company. Now, the highly uneven distribution of venture capital returns is the reason why we have the power law, where a small number of investments generate the vast majority of a fund's return. So I just told you a case of, Paystack. For example, Paystack raised less than $10 million and they exited for about, the news says it's 200. I believe, it's more than 200. And you can imagine what that means for early stage investors. Like literally, YC, which is one of the early investors of Paystack, literally made more money from Paystack than all the money it invested in African startup at that point in time, which is 2020. Now, there are different types of funding, or I'll call it types of funding round. There's family and friend, which some people call friend, family, and fools. This type of capital is raised from individuals who have a close relationship or close connection with the founder. They just want to support you. You tell them about your idea, which is likely not going to go anywhere, and they just say, what, take my $1,000, take my $2,000, and the founder can use that to really test the idea. Venture capital investment is typically not part of this round. Then there are angel rounds where you go to these guys that have a lot of money. They are happy to invest They come in during your pre-seed and seed round, but literally, as part of a syndicate. A syndicate is literally like a group, and group of investors, angel investors, they come together, pull their money together, and put it into a startup. Now, there's now the pre-seed round. A pre-seed round is literally like the earliest stage of a startup funding from a VC. And when founders raise pre-seed, they use this to develop an initial idea that they have. They go to market, validate it, and prepare for a seed round. Typically, this pre-seed is between about 25K to 500K. Please, I beg you, please, in no way should you, anyway, we'll get to that point. In no way should you choose or select checks randomly, because as I told earlier, I see a lot of people trying to dismiss. I mean, you can ask questions later on at the end of the day. But in no way should anybody just dismiss checks. I've seen people just say, "Oh, we're not taking anything less than 20, 50,000, 100,000." Especially for pre-seed, you're coming in, like, a lot of things are still unproven. There's a lot of question marks. Anyway, seed round. A seed round is the startup's first significant funding from external investors like VCs. It's typically used to develop the product even further, validate the market demand, and build early traction before scaling extensively. Now, you typically prepare after your seed round for a Series A round. And typical check size is between around 500 to 5 million. So after the seed round, you now have the Series A. The Series A is like labeled alphabetically ABC. I've seen up to H, where a company continues to raise their proven product market fit, they continue to raise subsequently till either they get acquired or they IPO. And then there are mega rounds, like the one that Moneypoint did recently, where they did over $100 million in that last round. And then there is now a case of a bridge round. A bridge round is a short-term financing round where additional capital is injected into the business to sustain operations until they get to a point where they have a larger funding round. Typically it's supposed to occur between a Series A, B, or C, or even an acquisition. But there are times when founders might actually run out of cash and they need to raise the bridge round. There are up rounds, down rounds, flat rounds. A up round is when the valuation has a up. Yeah. When the next valuation, the next round is lower than the previous round. That's when all the investors have a haircut. And the flat round occurs when the valuation does not change between two rounds. I think that's quite obvious. So, how do you determine how much to raise? I think before we even dive into it, we need to talk about a couple of concepts here. Stocks, represent ownership in a company, and shares a portion of stocks at attractive or provide attractive packages for remuneration for their employees compared to established companies. So that's why they have the option pool. I don't think we want to go into all those ones. I just wanted to highlight that. Now, the typical size of option pool varies. There's some that have 20%, some have 10, some have 15. I think most of them are actually within 10%. Now, common stock and preferred stock, I think we want to dwell on this one a little bit. Now, they have different rights, preferences, and privileges, right? Common stockholders are founders, employees, and or advisors. They typically earn their equity in exchange for their efforts, called sweat equity. And for preferred stockholders, they don't earn their equity. They buy it. That's what VCs do. We give you money into your business to support your startup to grow even further. And in exchange, we sign a document that shows that we have ownership, partial ownership of that company. When companies raise money, they sell preferred stock to investors, not common stocks. And I think this knowledge is very critical, maybe not now, but further in the future for any startup that gets to that point where there has to be a clear distinction. So the difference in stock classes impact how VCs can control or influence your company. When it comes to determining an amount to raise from an investor, a vital distinction is that preferred stocks get a preference or preferential treatment in a liquidity event. So in the case where a company is shutting down or it's getting acquired, like in the case of the $200 million that the news, in quotes, said that Paystack was acquired for, investors get in order of priority after sorting out taxes, I believe, and then I think maybe some creditors or debtors or whatever. The next set of people that you have to sort out are your preferred stockholders. I don't know if I got that order right, but I know the preferred stockholders get preferential treatment in the liquidity event. So acquisition, IPO, or in the case where the business is shutting down. So founders and employees don't get paid until investors do. So except for edge cases, right, where investors will, ask for a common stock, but the real thing is that investors will always prefer to have a preferred stock because it kind of protects them. Now, for a person to legally own, I think this also goes into corporate governance slightly. For a person to legally own shares in a company, they have to buy them at a set price. Now, because most startups are starting early, at the beginning, the company is worth nothing, to be honest. It's just two people with an idea and they can write code. And the lawyer deems, the startup to be at 0.00 whatever, a fraction of a cent, right, per share at an acceptable price. And if, let's say, two founders come together, that means they're splitting the company into 250 most times, or sometimes, where each founder will buy the share, this stated price on the screen. And it will amount, for example, if we're saying if the company issued about 10 million shares at that price, $0.001, that means the total cost of all the shares will be about 1,000. If you split into two, that's 500 per person. And if you consider the fact that, $500 is quite, it's a sizable amount converted to Naira, but if you consider the fact that the founders have probably bought domain, they paid for a couple of things, it's just their own way of, contributing to buying their shares somehow. It's a small amount, but it's just legal formality to establish legitimate ownership. Now, the real concept we want to dwell on a little bit more is dilution. And this is like a very key part that founders don't think about. People just want to raise money. And it's unfortunate that we're at the point in the ecosystem where people just feel every time there's a fundraising announcement, we should celebrate. When there's a fundraising announcement, you're losing a major portion of your company. You're getting heavily diluted. Dilution is a reduction in ownership on a percentage basis. So you started with 50%. By the time you raise some significant amount of money, you're probably down to maybe like 10 or 12%, right? And you want to be able to make sure that you consider how much you're raising and for what reason and how much time to buy you. We'll talk about that, in a moment. So when you consider the fact that you're reducing your ownership on a percentage basis, every time you're bringing in new investors, you want to think about why you're taking that check, how you maximize that, that money that is being invested to fast track your growth. So let's say practically, two founders come together, they split the business into two, 50-50, and they have I know most of them incorporate at about 10 million shares or about 1 million, but advisable 10 million start is a good start. And they kind of own 50%. That means they have about 5 million each. If they set aside 10% of their 10 million, that means 1 million shares is reserved for their employees as future equity incentives. And as much as I've known or seen, I've seen most people do 10% for employee stock option option pool, as it's called. Sometimes 20%. But that means the founder are left with about 8 million each. That's 4 million per person. So if you consider the fact that you want to incentivize employees to join you and you're going fast and their stocks will be worth something later in the future after vesting, this is one way you can actually put it out there to potential talent to join your company. Dilution is frequently overlooked by founders, and I've seen this many times. There's a lot of variability around how much a company should sell at what stage. And I think it differs from company to company and geography to geography. In the US, you'll say, at pre-seed, you want to sell at least 15% and 25% at seed stage, 25% at Series A, and 20% at Series B. If you add everything together, that's about 85% of the company gone by Series B stage. There's a company and that's a funny story, but there's a company that went public and the founder had a single-digit percentage point in terms of ownership. That's Box. So Aaron Levy got to a point where the business was struggling at some point, and they had to sell. They had to invest on it. They had to sell a major portion of the company. And the company got heavily diluted. The CEO himself took a hit on his own position in the company. Like he lost a lot of ownership. And by the time they got to IPO, he had about less than 6% of the company. Even his co-founders had more percentage than he did. So you want to remember that raising money is not a success. I'll say it again, raising money is not a success. It is not a success. It is not a badge of success. I just told you about how Paystack raised less than 10 million. Go and check how much their competitors or competitive alliances have raised, right? Raising money is not the mark of success. Money is just a means to an end. It's supposed to fetch you things, fetch you people, resources to get to the mark. $100 million in revenue, if possible, or $1 billion in compounded revenue. So raise carefully. I know people don't like to hear it. They want to raise millions of dollars, and then they get heavily diluted. All right. Any conversation about dilution is often taken outside of the real context, which is valuation. When people announce valuation, we tend to celebrate it. I mean, it's fine, but that is kind of like misleading. People tend to think that all this fundraising announcement it's for a reason. When people go to TechCrunch, Bloomberg, or whatever and announce it, it's also driving traffic to them in some ways. And also putting them, under a spotlight for future investors that would invest in that type of profile of a startup. It's not just that you're celebrating. I think that's where people kind of mislead it because they're outside. They don't understand the meta strategy to announcing fundraising or fundraise. So I think when people celebrate it, I don't know any reason why I want to celebrate selling 20% or 25% of my startup for money, right? When I know the startup is going to be valued much more in the future. So you want to be very efficient in how you use your startup. Reduce the money that you've raised for your startup. Valuation is determined, by price per share, especially and particularly in a price round. The price round is a Series A round. Typically, it's usually a Series A round. And the higher the valuation, rather, the less ownership founders have to sell to raise the same fund. So founders seeking venture capital how much of their company they are willing to sell in order to get it. When VCs also assess companies, they do their own analysis of a company and how they arrive at the valuation. You can't come to me at Microtraction and tell me your company is worth 10 million. And you're really proceed. How do you know that this is an erroneous approach to how you arrive at that? You tell me that's how other people are raising that. You're not other people. That's number one. Number two, if I ask you how to justify or ask you to justify why you are raising at 10 million, even if 5 million is very high for a VC and for a pre-seed company, I'll be very frank with you guys. Like, it's literally, like I told you, it's the forcing function. If you raise at 5 million and the market you're raising at is in this kind of situation we are in, 1,500 to $1, and you're making revenue in Naira, you have to work twice as hard, to earn the equivalent in USD, because the Naira can be, as we know, it is downtrodden. It can actually take a hit and be devalued in the next 2 months. Who knows? It has happened before. And we've seen this in-house, where fantastic founders, fantastic operators, doing great things, as we know them to do, really hardworking people, but they are earning the revenue in Naira, and you see this devaluation, they have to benchmark it against the dollar because they raised USD from VCs. You don't just come and say your business is worth $10 million. Do you know how much $10 million is in Naira? That's a lot of money, right? Yeah.
So I think we're like 1 hour past, right? And if you could just run through the slides, and then so we can have like some maybe 15-20 minutes for questions so that we can let everyone go. I mean, if you guys still want to stay and enjoy the class, master class, I'm not running over here. I just want to make sure like we manage the time very well so that everyone.
No problem.
Yeah.
No problem. I just wanted to be thorough so that we don't have to spend too much time on Q&A. But yeah, I'll run through it.
Yeah.
So when you're raising your first round, chances are very high you will have to sign a safe or sometimes convertible note. These are financial instruments. So a safe and a convertible note are not the same thing. If you're raising a convertible note, I think there are times when you need to understand why and how they differ. For the safe, it's an investment contract, right? Where investors grant you an investment for future equity. It's not equity and it's not debt like convertible note. A convertible note is a short-term debt instrument that converts into equity in a future financing round. You want to use convertible notes if you have a timeline for conversion. And investors tend to prefer to use convertible notes because it earns them interest and there's a maturity date. As you know, most startups die, and some investors are risk. They have a very funny risk appetite. So they might want to use convertible notes. You also, you see cases where convertible notes are used because you want to push leverage, or you need leverage to push towards an equity round. On the other side, we have safes. Safes are more founder friendly. Safes, in full, it means simple agreement for future equity was developed by YC many years ago, I think 2013 or there, or 2018. And it's very simple. It's not debt. It does not have a maturity deadline. And investors, VCs, angels, and even accelerators tend to adopt it. I think this is much more of how the features are defined. There's no repayment for safes. That's not the same for convertible notes. For maturity dates, you have about 20 to 24 months for maturity dates for convertible notes, not the same for safes. The interest rate for convertible notes is about 2 to 8%. There's no interest accrued on safes. Conversion event, safes convert for taking. Bayomi, can you hear me?
Yes.
Okay, I thought I heard something. So safes, only convert at the future equity round. Future equity round being a pricing round, as we discussed earlier, most times the Series A. And for convertible, we convert at a future equity round or maturity date. So there's also term sheets, right? I won't dwell too much on it because I assume that most people here are raising their first round, so pre-seed or angel round. But the difference between a safe and a term sheets typically come around your Series A, your seed round, Series A, pre-Series A, Series B, and beyond. The safe is literally just, like I explained earlier, it's an agreement between you and an investor, and that agreement is that they are giving you money for future equity, pending, the different subsequent rounds you're going to raise at. I'm not going to dwell too much on this. I'll just talk about pre-money valuation, post-money valuation, since we're almost out of time. Pre-money valuation, you can calculate it post-money minus your investment round. Post-money valuation is pre-money valuation plus investment amount. So I'll run that again. A company's valuation is expressed in two ways: pre-money valuation and post-money valuation. Just a fancy way of saying before I add money and after I add money to your business. So if your business is, say, $1 million pre-money valuation, and after you have raised all your round, like the entire round that you are raising for, you raised 500. Before it was 1 million. After raising, the 500K, it becomes 1.5. So your pre-money valuation is $1 million. The post-money valuation is $1.5 million. I think that's as simple as it is. But now it now becomes very key for you to know how much you're selling for your company, or how much you're selling for the money you are getting. So if I say, for example, Microtraction will invest 100K for 7%, you can run the math quickly, pull out your calculator, and do 100,000 divided by 0.07. That's 7%, right? 0.07. It will give you a figure. So that figure that it gives you is the valuation. That's the valuation. Like the post-money valuation can be realized by dividing the amount of money invested by the percentage sold. So if you say, in this round we are selling 10% and we're looking to raise 500,000, you're already putting yourself you're putting yourself, giving yourself a post-money valuation. So 500K we're selling 10%, or 500K for 10%. And then there's about cap tables. I won't dwell so much on it, but you want to make sure that when you're signing all these documents, stock options, shares to investors, you want to detail it clearly on your cap table. People tend to wait till they start raising money or raise a lot of money before they start keeping track of their cap table. I think that's a very misleading approach towards managing the cap table, because at the end of the day, when there's a liquidity event, your cap is a source of truth. That is supposed to capture every investor, what they own, at what amount, what type of ownership they have, everything. like everything that they have. And if you don't know how to manage your capital, I suggest you go to use Raise. Raise the Microtraction www.raise.africa. So how do you determine how much you raise? I think the first thing is to determine your cost. How much does it cost you to run your business? I'll leave all these fancy things that you're seeing on this slide. Businesses run out, most startups that I've seen die because they run out of money. And most people just think they want to raise for raising's sake. You need to figure out how much it costs you to run your business. And I personally have been, I've been in an institution whereby I have identified or scanned through the profile of people's burn rate. You want to consider how much you spend in a month to run the business. You also want to consider that you have certain amount of money in the bank, and for you to calculate your burn rate and calculate your runway is not always the same thing. I mean, burn rate is how much you spend monthly, and it's expressed by subtracting your expenses from your revenue. That is your net burn. And your gross burn is by total expenses before revenue. Now, if you want to calculate your runway, that is your cash and bank balance, your bank balance divided by your monthly burn rate, right? And then you want to also make sure that when you're trying to raise money, you're raising for about 18 to 24 months, or let's say conservatively, you raise about 12 to 24 months. This is the profile of of most startups burn rate. You see them spend 50 to 70% of their money on salaries. A couple of them spend a lot of money on cloud infrastructure, sales and marketing, and office. This office one is quite debatable. But for me, I think if you're a very small startup, I think you should work or run remotely because it will save you a lot of money on office space, to be honest. Ultra lean startups, very, very lean burn rates tend to have salaries and benefits much. I mean, this is how the profile is. You see them spend more money on salaries. That means everybody you are bringing to join your company, they have to be contributing something significant. You can't bring dead weight into the company. Unfortunately, most people tend to do people a favor by hiring them. Everyone coming on board has to have an exponential value they are contributing to the success of the startup. Remember, you're also on the timeline, the same as your investors. Your cloud infrastructure also contributes to a lot of money. People need to figure out how to go to market, before spending a lot of money on SEO and ads. I see a lot of founders trying to get, VC money to go and run ads. I think, anyway, this is not for us to talk about on this call because this is for funny. But you need to actually think about a proprietary approach towards going to market. How do people find what you are building? How do people looking for you find you? Think about it from first principle, very key. So you might ask yourself, why do VCs always ask people to register in the US, Delaware, blah, blah, blah? It's because in Africa, on the global south, we don't have strong legal framework for businesses. So it protects business, protects all these VCs because there's strong corporate governance in the US or in all these places. You have US, Cayman Islands, Singapore, Canada. These are literally some of the, I think, the most prominent one that VCs ask founders to create a company in, and then they run a flip. So you might have registered in Nigeria, but before you receive funding from Microtraction, we want to see a Delaware incorporation, and we invest in your hold co. So the holding company, being the Delaware company, will own Nigerian entity, and that's why they say you have to flip it. So if you have registered in Nigeria, fine, but you need to register in Delaware. That way, investors can invest in the Delaware corporation that owns the Nigeria entity. And this is the reason, access to capital, easier exit, because some companies don't, buy from different jurisdictions. They won't buy from places that have. It makes M&A very smooth, right? Tax efficiency, standardization, blah blah blah. Now there are currently people that just sign, checks and sign agreements with investors. They don't understand the full implication of what they're signing. There are some investors that you would sign an agreement with, and in the agreement you're signing is a clause for anti-dilution, which means even in the case of a down round, they will never get diluted. And the effect on you as a founder means that there's more dilution for you, even if your valuation drops. There's also liquidity preference. Sometimes, and this is what we call debt economics, right? In the case of a price round, VCs can even get 2x their money, even if the company is dying. There are cases like that. So founders or employees might get nothing in a low exit scenario. There's some companies that have been sold, but for some reasons, the founders don't even have any money. They've worked 5 years, 6 years, 7 years, and they brought in investors that have liquidity preference of about 2x, 3x, which means if the company dies, 3x the money I put in, I must get it. It's a must. I remember they have preferred stocks, right? So the next one is redemption right. In a case where investors can force the company to buy back their own share after a set period of time, remember the investors are also on the clock. If you don't have an exit or a liquidity event, they might force you to buy back your shares, and that comes at a very expensive rate. That pressures the company to either exit, even if they are not ready. Pay to play. Investors, what this does means, it means investors must participate in future rounds or they lose the right. The effect on founders is it forces continuous VC support to penalize inactive investors. And I'll drag along right. We can go on and on, all right? But the real thing is that founders must understand where debt economics come into some of this agreement. I'm not sure some of you feel that, when you're doing your VC, but always take a note to go through some of the agreements, ask for legal oversight. Now, when you want to get, let me just take a pause in case we didn't even cover this, but I think we're already done. Let me just take a pause on this. So how do you get people to even invest in you? It's fine to go to mixers, all right? It's fine to go to all of these events, but you want to understand what type of investor will invest in my company. Like I already explained, there are different types of investment firms, VC firms, and start from there. When you identify, okay, it's a Microtraction, if you go to our partners, they don't have time. I'm very frank. Of course, they'll listen to you, they'll get your deck or ask you to apply to Microtraction. But you want to make sure you have people that are going to listen to you. Like even if it's not Microtraction, any VC firm, identify who the associates are, identify who the analysts are. From there, try and send them either a cold email, send them a message on LinkedIn, and see to it that they have your deck. Because even if you give your deck to a partner at the fund, they're still going to come back to give it to an associate or an analyst to screen that deal. They call it deal screen. So the entire point of meeting an investor, say you get one, is not to close them immediately. I've seen cases where people want to just get the money the next day. You want to close gradually. You want to book the next meeting. Investors really commit on the first pitch, no matter how brilliant you are. They want to book as many meetings as possible and make sure that they are understanding more of your business, understanding you as a person. And at the end of the day, the whole idea is that when you speak to them, you know exactly what they are looking for. That's the reason why I had to explain generalist firms, thematic firms, and thesis-driven VC firms. Some firms don't invest in certain type of company because of their philosophy. You want to understand who you are speaking to, and please don't lie to a new VC. You will eventually find out. So you don't want to embellish the fact. I don't want to misrepresent the fact. Pitch exactly why your product is a must-have. If you have demo, I think it helps. Talk more about your team. Your team is actually one of the things that people usually overlook. If you tell me you want a paystack, fine, but what exactly do you do at paystack? Because back channeling is something we do, and you don't want to know how expensive our network is. We speak to people across different verticals, across different companies, so you don't want to lie. And also try and point out why this is the next billion-dollar opportunity. And when VCs are talking, you want to give them a chance to you want to listen more, because perhaps they have seen a deal like yours that didn't work out, and they're trying to figure out why exactly this one's a different case. You want to build a connection with the fund, and even if they don't invest in you, try and keep them up to date. I think most people miss out on an idea of investor relationship even before they even invest. If you're not so into writing investors updates on a monthly basis, please do. Even if they have not invested in you and you have their email, send them an update at the end of the month. Keep it in practice. All right? You want to master how to deliver a story. We're not going to talk about that because this is not about pitching. So investors tend to back funds that have compelling vision. It's not about lying. It's about how you deliver your. If I ask some people to describe their company, they have a long-winded way of describing your company. There's a refined way of describing a business. You want to perfect your pitch, and it takes a ton of practice, especially for technical founders that they don't have so much proficiency in storytelling or expression or articulate expression. You want to find a style that works for you and practice relentlessly, because this is your job eventually. So you want to have confidence. You also want to be, humble, because in as much as you know a lot, you don't have all the knowledge, unfortunately. I think one part is, due diligence. Even if they say they want to invest in you, it's also subject to due diligence. This is just a snapshot of one page of what we ask for when we are doing due diligence. I mean, we can like you, we can like what you're building, we can think you're the next level 5, we can think you're the next carry wise. But if we do due diligence on you, your company, your product, and it doesn't check out, we back out immediately. So every investment is still subject to due diligence. At the end of the day, they'll close. I mean, you've negotiated on valuation, whatever, and then you're signing the safe. The safe is typically a standard agreement document that is signed. Maybe in your case, it's a convertible note. And like I said, investors, you want to bring investors on board that will add value. Value addition is very key, especially for, I don't know about other investors, but for us in Microtraction, we are strongly on value addition. And that differs from fund to fund. I think a very good example would be Microsoft. Microsoft did not raise any venture capital except for the exception of one person that they had to bring on board because they saw his position in their board of directors critical to their progress. They didn't need to bring anybody on. They were profitable, so they didn't need to bring any money into the company. Identify everyone's superpower on your cap table. Don't just collect money from any random Jack and Harry, right? And then when you're closing all your investment process, you want to make sure you're signing, the safe through DocuSign. You keep a copy of it. Make sure your data room is up to date. Make sure every necessary information is captured properly and accounted for. And I think that's it. I mean, thank you for extensive attention. My name is Ofyong, VC at Microtraction. You can always send me an email. You can connect on LinkedIn. Thank you very much.
Thank you so much, Ofyong. That was really, really amazing. I'm sure everyone has learnt a bit or two, right? Without wasting too much time, I think we have a number of hands raised already. If you have any question, please raise your hand, and then we can take the questions one at a time. Please keep it brief, right? We've already spent over 1 hour 25 minutes, so let's keep it brief. Peter, are you here?
Yes, I'm here.
Okay, awesome. Please shoot.
All right. So I want to know if there is uh, like a structured kind of uh, place you can invest, like maybe someone that is interested, like an angel investor or something. Does Microtraction have some like ETF? You can just put the money there and they, invest and you get your return. So instead of like trying to do it yourself. So I think what you just asked is if an angel wants to invest into Microtraction. For now, we're not raising, but when we raise, we typically just the way I just told everyone. If you are raising, look for people that have superpower. Like we don't just raise money from anyone. Some of our backers, you search on Google, Microtractions, limited partners or our LPs are likes of Alexis Ohanian, founder of Reddit, Michael Sabel, former president of Y Combinator, and many more. Like we pick people from relationship, people that we know, people that have value addition for our startup. So yeah, I agree. Yeah, there are funds that have syndicates or that allow people to come on board, but this is literally outside of my own remit. That's for our partners to decide. But I know the profile of our LPs. But yeah, for now, we're not raising. Thank you very much, Peter. All right.
Thank you, Peter. I left a name in the comment section. It's called Oak. So you could they take on individuals. It's a syndicate basically. So you can check their website and then or send them a message on Instagram to learn more about how to like they'll take your money and then invest in startups for you basically. Um, yeah.
Okay. All right.
Yeah.
Thanks.
Adiola, you're next.
Good evening. For startups that you are not based in tech. You are more or less like building quality in people. It's not easy to define the premises of how much you will make. So how then do you go about evaluating your company? Okay, I mean, I'm not sure if that captures the description of the business, but for let me give a better description of the company. No. The crux of the matter is how do you value your business, right? I think yes, in that kind of niche. In regardless of the niche, in fact, I think I would advise most people not to raise at a ridiculous valuation. Don't raise at a ridiculous valuation that will hurt your chances of raising the next valuation. Like I said earlier, if you raise at a 5 million valuation and you're going to raise your next round, people are going to ask you, okay, so you raised 500,000 at 5 million valuation. Now you're coming back to raise at a 12 million valuation. Revenue is less than $5,000. Like, how do you justify the 15 million or 12 million valuation you're going to raise at? So you should think more about, okay, how can I raise a minimal amount to be optimal to run this business? That's the reason why I took more time to explain about the bond rate, the profile of the bond rate. You want to make sure, maybe perhaps you run your valuation between 2 to like 3 million for a pre-seed. Optimizing so much on a pre-seed valuation, I think is just a waste of time. What you need is people that can really help you. People that can pre-seed or seed. And there are even investors that don't do more than a certain valuation range because it hurts their fund economics. And I already explained why. I think I explained why over the course of the thing. So not to dwell too much on that point, but you want to raise at a very reasonable valuation, maybe 2, 2.5, or max 3.
Yes, thank you. I think also maybe you probably don't even need VC funding. If it's the way it's described, it seems more like an NGO, right? So maybe look towards
Exactly.
more. So maybe look for grants. There are organizations that will give you money to develop people, right? So maybe look towards and grants. You don't have to return it, right? Yeah. So maybe think around like other funding options. Joshua, is it?
Yeah. Okay, thank you for this. So my question here is that I have seen a lot of people that like they can afford their startup, like they have millions, but let's say somebody have over $2 million, and then he starts building a startup, and he end up going to investors to maybe raise 200K or something like that. So my question is, why do such things happen in the industry? Yeah, very good question. Not everyone, you can't do everything by yourself. There are investors that have very strong relationship with regulators. There are investors that have very strong relationship figuring out or navigating regulatory issues for example, fintechs. You want to bring on, like I talked about the case of Microsoft. They brought in somebody not because they needed the money, but because they saw the experience, the value the person brought to the table. And that's the reason why I said investors should have value addition to your company. It's not only money. Anybody can give you money, right? Any VC money is a capital, like it's a commodity. Any other person can have money to invest in you, but you want to bring on people that can make your life easier. Like for Paystack, for example, their biggest investor was Stripe, and Stripe literally acquired them. So you need to figure out people that will come on board and make your life easier, not just because they have money. Some people might be good at growth. You want to get their money because they will help you, serve as a springboard or serve as a sounding board rather to refine your growth strategy. Some might be good at hiring because if they have worked at different companies, they have a good sense of what a high quality bar for hiring talent looks like. Some can join the startup to help you design your operational system. So it's not only about, okay, I have money than the VC. Why should I collect money from them? There are much more things that can be added than money. You don't want to just focus majorly on money. Yeah.
Thank you so much. Obioma.
Good evening. Good evening, everyone. Yes, my name is Obioma. I'm a third year computer science student here in the University of Ibadan. So I'm actually a front-end engineer and a product manager. And most times, especially with startups, when they are not able to like meet the quota of payments, they try and come in over sweat equity. But most times, I'm not usually a fan of their idea, and most times the sweat equity is more or less like a waste of time to begin with. So, and later, me personally, I have my own projects, like one of the startups I'm currently working on. So now the idea is this: I don't want to directly be involved with some of this agreement and my projects personally too. So I tried coming up with like a tech agency, like a company that would like take this sweat equity, and if possible, if or when I'm launching my own startup, I would like the company to like own the ownership of this my startup, maybe like a large percentage, and start fractioning out the remaining percentage to
68.
whatever investors I bring in. So my question now is this: is it possible to have that
we had
agency
about
like just the
something,
way
77.
America is now? They have like a bursary that is able to like invest. So I will have that company. So it should just be so me. My name won't be on this contract, but it should be. My name won't be on this contract, but it should be.
You just sit down there. You've been lying down all day. You finish this food.
Yo, that was becoming chaotic. Um, Obioma, if you could come up again and just say your question. I
Say
think
your question. I think.
yeah,
Yeah. Is it possible? Can you hear me now?
yes.
Is it possible for me to separate myself, Obioma, from like by coming up with a company, maybe like a tech agency that takes things like sweat equity and also takes the ownership of like maybe my personal project or my personal product? You get, so that way if I'm signing a contract, I'll be signing it in my company's name, especially when some companies want to pay
Do you have
pay me for terms of sweat equity.
this company
This
registered already?
registered already? Yes, PSC, as long as PSC counts, it's called Karma.
Okay.
But
So I think you already
we are
figured
still
that
working
out.
on the grad director. Yeah. So I know, I just want to know whether something like that exists, and nobody should be able to like buy into that company. So the company will just be mine. So it will just be collecting all my sweat equity or all my products. Because because when I was like trying to tell some of my team members, they were like trying to say that they also have shares. I mean, I'm like, no, that this is different from whatever product they are building.
Hello?
Yeah, I can hear you. Sorry, I can hear you, yes, sir.
Option, do you want to take
a stab at that?
Yeah, sure. So first thing is, I've seen startups invest in startup, right? And understand that time it comes with there are nuances in this thing, right? I've seen competitors invest in each other because they think that there is like a mutually beneficial outcome for them. That happens. But I think what you should be careful is you don't want to set up a structure that eventually implicates you in some way, shape, or form. So I would suggest, in as much as it sounds, practically it sounds like you're not doing anything bad, but I highly recommend you speak to the corporate lawyer, right? So that we don't have enough time to expand on what the structure of your company looks like. We want to make sure that with a lawyer to tell you the second order effect of whatever you're going into.
Thank you. Chidera, please let's keep the questions very short. Thank you.
All right. Thank you very much, Mr. Offion. So my question is, for a startup that does not have information on the market size, is not available, especially the one in Africa. How do we navigate that? A startup that there's no info on the market size and market dynamics, but is a problem or no info on the market size because somebody has not built on it before. So how do we navigate that?
I think I already did an example of that. I don't know what time you joined the call, but I did a market sizing approach. You want to is a hypothetical scenario. You want to run it by assuming the number of prospective users that you have for this business, how much you're willing to pay either on a monthly basis you
My premium
extrapolate
to
it in
the
a
end
year,
now.
you can be able to, you'll be able to identify the
Understand?
annual revenue
My
opportunity.
premium to the end.
So if you think about it from that way, that should give you a much, if you can identify the annual revenue opportunity, should give you an idea of what the total market size should look like. Because I know I spent too much time on, I don't know what time you joined the call, but I spent too much time on bottom up sizing. Like, you want to do Google search this or find out more about bottom up market size approach. It's a very straightforward way. You use assumption and hypotheticals to get to that point where you have an idea of what your market size looks like, realistically or using assumptions.
All right, thank you very much.
Yeah.
Ikechukwu, Offiong, please let's also keep the answers as short as possible. Time is we have like 14 minutes.
No problem.
Thank you so much.
Okay.
Thank you so much. So the question I had was, so what if you have like employees, people that are working for you? Is it a smart idea to pay them in like company shares? Like you give them this amount of shares instead of outrightly giving them money.
That's
To pay people, you have to pay people. But there is, I think I also talked about it. You have to, some companies, not even some companies typically have employee option pool, but you have to pay people, please. So, in as much as, because we're living in Nigeria, right? You don't buy bread or whatever with stocks, and those stocks are illiquid. They don't convert until later. But you typically have cases where, startups incentivize employees with this stock option, and they there's a vesting period. Some vesting periods are 2 years, some are 4 years. Doesn't mean that the company is going to just issue out those shares now and the employee gets it immediately. They have to stay for about 2 to 4 years in certain cases. I didn't really expand on that point because I don't think it was quite necessary to dwell so much on it. But yeah, please pay people, and you can always incentivize them with employee options. Yeah.
Global talents go chop too.
Yes, please.
Agunbiade, please. Yeah.
Yeah, thank you, Bayomi. So, thank you, Phil. My question is just on equity split among co-founders. So, for a solo founder now, for instance, that has gone about the product development, paid designer, just going about development and with developers, and going about registration also, and now trying to bring in a co-founder on board. So, and also trying to allocate percentage to that co-founder, equity and stuff like that. So, if I'm to give out that equity, am I to get the exact amount for that percentage based on the valuation of the startup, or that equity percentage goes out freely to the co-founder, or is there money that's going to be paid to acquire that percentage as a co-founder?
So, the reason why I use that example of people bringing 500 is just, like I said, it's a legal formality. Because eventually, as co-founders, let's say you guys started together at the same time, you would have bought things. Agumbiade, okay, as Agumbiade, I'm going to buy the domain. You probably buy something like, let's say, pay for Slack or whatever it is, right? But I think for deciding how much percentage will be split across, you need to consider the value the person is bringing on board. If the person is going to be complimenting you in a very significant way, I think it's fair that you sit down and discuss what a strong double percentage. Depends on you, but I think it's fair if the person is complimenting you to a great extent that you consider a double-digit percentage equity ownership. But you need to also consider the fact that you guys, I think more than the equity percentage, you want to consider that you guys are in sync in terms of viewpoint.
People want me to create a
And much
WhatsApp
more.
group.
Okay, thank you.
Yeah, people that join.
Yeah.
Caller.
Hi everyone.
Yeah.
My question is, what are the benefits of VC to a startup? I know that there are benefits, but I'm not sure you mentioned any. And I want you to use Microtraction as an example, in that they have helped a couple of businesses to grow. So, what are the benefits? Are they going to hold your hand through a lot of processes, help you open some doors, and all of that? Thanks.
Yeah, good question. So every time we go to discuss about companies, what we ask ourselves is value addition. If we can't see value addition, it becomes very difficult for us to even want to even invest. We in-house, we are designing a process where founders can actually get go-to-market strategies seamlessly that they can experiment on. It's something that's only affordable to people that are within the Microtraction portfolio. We have a system that allows founders to leverage our network. I just talked about our LPs. Our LPs, extend into Asia, Silicon Valley especially. We have a lot of our LPs in Silicon Valley. So we're talking about opening doors. We want to get in front of Michael Sidel. It's just an email away, and you know what that does. And especially when it's something of value to the startup itself. So network, the relationship we can help you, provide you to help you navigate setting landmines, because there are a lot of things that founders don't know until when they start building, they need to experience some of these roadblocks. And go-to-market strategy seems to be something that is top of mind. B2B sales is something that a lot of founders are struggling with. It's not spoken about. It's a spoken elephant in the room. And we are actively helping founders think through that process. But unfortunately, most founders are not open-minded to receiving advice from VCs. And I think it's fair because they have the front row seat and the backstage view of what exactly works in a startup. But most times, we encourage founders to open their mind to exploring other options, other ideas that will come from VC, because we have seen many things. Regardless of whatever you're building, we have seen many guys try and build, in that same space. So yes, we come in with network, we come in with, go-to-market strategies, which is something that we actively do on a recurring basis with our startups. We also help our founders with fundraising support. We help them get in front of people that are that are going to invest in them. We are focused on pre-seed. We know people that are friends of our own VC firm that are focused on seed stage. We know many that are on Series A. We don't gatekeep deals. We put founders in front of people that are investing in them, either the ones that are in Africa or outside of Africa that are interested in coming to invest in African companies. So yeah, we do a lot more than just investing money.
Thank you, Ofyong. Esama, please help us and manage our time so that we can all. Yeah, thank you.
Okay, hello, I'm Ofyong. So I wanted to ask, Microtraction has invested in a lot of top African early startups. So what qualities do you guys really look out for in companies at the pre-seed stage? And from my understanding, pre-seed is pre-revenue, right? So what qualities do you look for at that stage?
I think I addressed this upfront, venture scalable, and that is very key for us, is the business venture scalable startup. But more importantly, about the pre-revenue part that you just mentioned. So we want to see a founder is able to execute. Do you have execution ability? It's not enough for you to have an idea. Unfortunately, people think that they have unique ideas. I see at least 200 pitch decks. I'm not joking. I'm very, very serious. I see a lot of pitch decks, more pitch deck than everybody, combined on this. I've seen a lot of people, and the ideas are almost very similar. So if you have an idea, say you had them for idea before read one, are you able to execute at a higher level, at the 10x level, right? This is not just about ideas. And if you tell me, I'm able to execute, okay, show me your track record. What have you done before? What project have you worked on before? I suggest that you have the ability to execute on a much larger scale. I don't know what time you joined, but I talked about venture scalability. Because starting a startup, like I said, is like the Olympics of business. It's ridiculously difficult. You are meeting people that are incredibly smart and also able to execute on a very, very high level. So yeah, we're looking for people that are building venture scalable startups within certain vertical focus areas, which we consider to be high signal across different verticals, and then people that are able to execute. And also one other element I've not mentioned is you have to have a very unique approach towards global distribution. I talked about, most Nigerian African startups are struggling to raise more rounds, primarily because their market is in Nigeria and even or maybe in Africa. And you notice that a lot of these founders are making money in local currency that are downtrodden, affected by inflation and devaluation, which means you have to work twice as hard, 3 times as hard to get even half as much in USD equivalent. I highly suggest that you start thinking about how to scale outside of African markets so your company can survive. It's literally like diversifying your market strategy. That's why we're asking more people to build locally, but have global in mind. We build local first. You can build for the local market, but what about the global market? It's not enough that we are only using the product in Nigeria or in Africa. You're using Notion, we're using Google Meet. Why can't we have the equivalent of Nigerian product in the US? Let them use our product and pay us in USD, right? You're not paying AWS in Nigeria, Naira, are you? You're paying in USD. So there's a reason why we're looking for certain startups that are, I'm taking too much time, but you get the point, right? We're looking for founders that execute. So, yeah.
So just one more thing. In the pre-seed stage, if you have like an MVP, you have certain traction on the MVP, would that be like also good to go?
It depends.
Traction.
It depends. I can't give you a yes or no answer because there are many factors in between to make a decision. Depends. Case by case, it depends. Yes.
Thank you.
Thank you too.
So we have less than 4 minutes, right? So I think we can do like 20 seconds for the question and 40 seconds for the answer. Easy spend. Offion, please. 40 seconds.
Sorry?
40 seconds for your
Okay,
answer.
can you hear me?
Yes, we can hear you.
Yeah.
Okay, good evening. I just want to find out how you would measure a company. Oh, okay, so EasySpend is a fintech company. Currently, we're trying to fix the FX scarcity. We're trying to see if we can fix it up. Something like LEM5, but in LEM5 that puts the remittance into use by giving it to importers to handle the dollars we get in from outside the country. We are currently registered in Delaware, and we are currently on the app and Google Play Store. But then we are already seeing
20
issues where we are
seconds.
going to require funding. Okay, so how would you evaluate a company of this nature?
There's no yes or no answer to this. There are many factors involved. What you just described is less than maybe a fraction of exactly what your company does. And we have investment thesis that addresses certain companies. So I suggest you speak to a VC, let them they have to screen the deal. It's not just I have an idea where to play store. So it depends. We have to examine exactly why this opportunity is a venture scalable opportunity. If you exactly can execute on this idea to the greatest level possible, and what your vision for this business looks like. Are you structured properly to maximize the opportunity you're addressing?
And also, I think that Ofyong is on LinkedIn as well as on Twitter, right? So after the call, you can always shoot him, just let him know that you are on the call, and then that should be easy to get an intro, so you can get a more personalized, yeah. Balogun.
All right, thank you.
Balogun.
Yes, I'm with you.
Yeah. Please, 20 seconds or 10 seconds.
So I already posted my question in the chat. So I said, do you know any program or bootcamp that can help new founders understand the whole business world, like everything, more like what we went through now? Because I'm someone that I'm just a software developer. Last year I started a company called Citrus Rates.
So Payment Log has a course for founders. You could take that. I'll just type it in the chat. Payment Log. Yeah.
Oh, awesome! Thank you.
I'm trying to take as many. Stella, please just shoot your question before we go off.
Hi. So I'm Stella, co-founder of an application called Tokam. My question is quite similar